Ladies and gentlemen, our second panel is going to be discussing emerging vulnerabilities in wholesale markets. As we've just been hearing from the Governor, there are now some very well understood vulnerabilities in things like Libor and FX, but a whole load of new vulnerabilities emerging as we go through a period of rapid change in markets and regulatory regimes. To moderate this panel, I'm very pleased to welcome Jonathan Holt, Head of KPMG's Financial Services Practice. Jonathan brings a wealth of experience from his interactions with clients at the sharp end of perhaps some of the problems that we'll be discussing. Jonathan.
Okay, and great to be here this afternoon. I'm John Holt. I'm Head of Financial Services at KPMG, and we are very proud of our association with the FMSB. I'm just joined today by a very distinguished panel. We're here to talk about emerging vulnerabilities in wholesale markets. So on my left, we've got James Kemp, who's the Managing Director of Global Financial Markets Association and an FMSB board member. Next to him, we've got Scott O'Malley, who's the CEO of the International Swaps and Derivative Association. Next to Scott, we've got Sir Dave Ramsden, Deputy Governor for Markets and Banking at the Bank of England. And finally, Manas Safa, Head of Markets, Europe and America at ANZ. So, and we've heard this all through the discussions earlier on. I think a great deal has been achieved 2 years on from the Fair and Effective Markets review and 10 years on from the financial crash. The industry has made big advances in terms of conduct reform, in terms of risk mitigation, and there have been a number of initiatives which I think would all agree have improved market discipline and market conduct. You know, the industry has taken responsibility, and I think that's a great credit to the industry. However, I think we would also all agree that we are on a journey and there are continuing emerging vulnerabilities, and that's the topic of our discussion today. And I'm going to start by talking about something which the Governor referred to, which was benchmark reform. And Scott, if you don't mind, can I start with you? A fairly broad question, but the transition across the globe from Libor to new benchmark rates is going to be a major change in wholesale markets. What are you doing in this area? What do you see as the key challenges and risks, and how are you managing that transition?
Well, thank you very much. Thank you for MFSB for having us here and including us. The Governor, I think, defined the problem quite well. Lack of verified transactions is going to require a transition to a new, more secure transaction-based environment. And it's also clear that that's really not up for negotiation. Andrew Bailey made a comment in July that by 2021, we're going to have a new benchmark that we're going to be working towards. And for the past 2 years, the official sector in the major jurisdictions, the US, here in the UK, Switzerland, Japan, and now yesterday, Europe announced its transition off of Euribor. So it's now incumbent for the industry to develop its solution and develop its transition. We've been working through essentially 3 work streams. And there is the European benchmark reform that goes live in January. I'm going to leave that aside. I don't want, it confuses the matter a bit, and it's quite complicated in and of itself. But I do want to talk about the two work streams that are very active in reference to the transition to a risk-free rate in all of these jurisdictions. So the new risk-free rate, Sonia selected here in the UK, it is a rate that is at least functioning today. SOFR in the United States will be unveiled in the first quarter of next year. Europe just announced its intention to take comment on Euribor. Japan has its process as well, as does Switzerland. So we're working towards these new risk-free rates. What does that mean to transfer the legacy book or the very long-term dated contracts that are going to be impacted by this transition between now and 2021? There's also a work stream in case it's related to fallbacks. If Euribor ceases to exist or doesn't exist past 2021, what do you do with the existing contracts and the existing trades? So we need a strategy for that. ISDA was asked to step in and develop fallbacks to the legal contracts. There are over $160 trillion written against interest rate, euro dollar, Libor contracts. It's a massive amount of contracts that are at risk right now in case Libor doesn't exist. I should point out, Libor has been strengthened, so it's in a much better situation today. So we're thinking about these. One, the fallback. What do we have to do to develop a solution around that? The next step is how do we transition the market? When Andrew Bailey made his comment back in July, my phone lit up, and they said, "What, is he kidding? Is it real? What do we do? The question the governor had to answer about term structures. Everybody said, well, I do have term structures. I don't have an overnight rate. What are my term structures going to be in the new rate? So we have to ask ourselves, what are the challenges and opportunities? Initially, there was a bit of a reluctance to go to a term structure. And I see the official sector did not want to recreate Libor. That's not an option. That is not on the table. So we have to figure out what brings liquidity together, right, focuses it, without replicating Libor. So ISDA has taken on the challenge, and we will be working with a number of trade associations and all of the industry participants, not only in the derivatives space, but also in the cash market, loan market, and others, to assess what our challenges are to transition to the new rate, develop solutions to these problems, and identify problems that have to be addressed immediately. The ARC, the U.S. effort, today the governor announced the new broadening of the sterling risk-free rate working group. Very important to include all walks of life. There are a number of people that have been very engaged in this transition. There are many, many people who have not been as closely following this.
Are you optimistic about the transition overall?
It's really not an option to fail. And we have to develop a strategy to adapt to the new rates. So we're going to survey the industry right now, globally in the 5 jurisdictions, to identify the issues and identify the possible solutions that have to be addressed, and figure out how we transition to get to new curves, to get to new products. We will engage derivatives, everybody else, and the infrastructure providers, people like clearinghouses and trade repository or trade execution facilities, to make sure that they're delivering services to support the transition.
Thank you. And Dave, I have to ask this question because the governor referred to it earlier on, but I mean, what's the bank's view of the financial stability risk from Libor and benchmark reform, and what action has been taken? And obviously we heard some of that earlier on.
Thanks for that. And before I answer it, just for many of you who won't know me, I'm new to being Deputy Governor of Markets and Banking. I'm just coming up to my 3rd month in the role. In my previous 29 years in the Treasury, I saw at first hand the Treasury's focus on FEMR and the Treasury's contribution to that, led by Charles Roxburgh, corralled by Andrew Hauser, who's getting lots of name checks down there. So when I came into the new role, it was a real priority for me to lead that work from the bank side. Had an early meeting with Mark Yallop, and it's great to be able to contribute to today's event. So on the specifics, actually I can still talk in these terms. I gave my first speech in my new role last week, and I stressed some of the issues that we're facing around benchmarks, and as others have emphasised already today, including the governor, the scarcity of transactions underlying Libor does pose a real risk to the medium-term sustainability of those benchmarks. And from a bank perspective, we recognise that the disruption to financial stability could be large in the event that Libor becomes unavailable, given the vast scale of contracts that we've all been talking about, in which Libor is the reference rate, and also given for the potential for lack of clarity on the legal position. And so earlier this year, and before I joined, but I'm now a member of the FPC, they assessed that market reliance on Libor was a real risk to financial stability. In terms of the 3 things we're doing, 2 of them across the authorities really and the market, 2 of them have already been talked about, so I'll focus on the 3rd. But obviously the sustainability of Libor through the transition can be made to alternative rates. That sustainability is critical. The FCA are leading on this. We'll hear from Andrew later, and it announced last Friday that all 20 of the panel banks have agreed to submit to Libor until the end of 2021. So that gives us some times. And obviously what happens beyond that is up to the benchmarks administrator, but Scott has been emphasising how important it is to make the transition. Then Scott, leading with ISDA, is coordinating work to make sure we have got robust fallbacks for Libor within derivatives documentation. What are we doing from the bank perspective? We've taken responsibility for reforming the SONIA benchmark, and in April next year we'll be taking on end-to-end administration of the SONIA benchmark. A key outcome of that will be a broader data set of both brokered and bilateral transactions, and we'll be collecting that as part of our routine data. And we're going to be publishing an assessment of our compliance with IOSCO principles for financial benchmarks. We want to make sure we've got that assurance as well as further external assurance. And I mean, just to finish, market participants are playing an incredibly active and important role, consistent with the entire approach of FMSB. In April, we got the recommendation from the working group on SONIA, and we're seeing similar progress in other jurisdictions. And just to bring it right up to date and to reinforce the announcements today, because I think those go to really important aspects of the themes of today's event, that the mandate and membership of the working group is going to be extended in order to catalyse a broad-based transition across a range of markets, as Scott was saying, bond, loan and derivative markets. And then really importantly, the membership is going to be broadened to get a much more diverse group of members. We were hearing in the first session how I think one of the early learnings from FMSB was getting more diverse groups in the room. And so we're learning that lesson with the way we are sort of extending the working group, and look at today's press notice for more details from that. But I think that should all should show the bank's commitment to this and to this incredibly important period we have ahead of us.
Thank you very much. Scott, one follow-up question, then we're going to broaden it out into some slightly broader questions. But what do you think the risks of adoption at different rates and different jurisdictions pose to the market?
I think that's a very good question. That'll be part of our survey, and that's why we're going to do all 5 major currencies to make sure that we understand, the questions between secured and unsecured. Possibly, I think we're going to see different term structures evolve. I think the governor is open to that, as are other jurisdictions. So how do those evolve and how to develop? So, over the next 3 months, we're going to conduct that survey. We'll get strong engagement and really unpack these issues.
Is there a risk that ultimately, at the end of all this benchmark reform is detrimental to markets when we're finished?
Listen, the governor laid it out. We're moving forward. We're going to more robust structures. The surveys are not very popular among survey banks to contribute to. There's there's some legal risk associated with that. I think we have to proceed forward.
Yeah. Okay. If anybody has any questions, I'm struggling a bit with my iPad, so we may have to do some roving mics later on. So I'll give you the opportunity later on. But I'd like to now move on to resilience and the effectiveness of the markets. And Manas, maybe a question for you. Do you think technological developments offer further opportunities to strengthen conduct and stability, or do you think they are a threat to the market?
Anything that provides more transparency has got to be good for markets. And I think technology to a great extent is going to provide that. Obviously, we have quite a bit of work to do to get there. And along the way, every time we have to take the focus away from that development into other areas. Obviously, it's delaying that. But I think the technological advances couldn't come sooner. On the other hand, I think technology is also has risk associated with it, and to a great extent, whether as algorithms or other systems, there is input. So we've got to obviously make sure whatever the inputs are into those systems are controlled or regulated in some shape or form as well. So going forward, I think as we are going to see a huge transition in our industry and actually in lots of other areas, with regards to technology, I think regulation needs to move with that as well.
And what's your view on cybersecurity in wholesale markets? I mean, do you think cybersecurity is an issue everywhere? But
Absolutely. I mean, if we just look at clearing, there is so much concentration risk, and clearly, the more concentration risk you get, the more risk of cybersecurity having a major impact on the whole market. And in general, there is so much information out there now Just looking at that development, cybersecurity becomes a significant risk for all activity in markets included.
James, do you have any particular views on it?
So I think that technology has a sort of double-edged sword. I mean, technology, the advancements at the moment mean that you've got new trading structures, new trading activity, which of course has the ability to bring with it conduct risk, etc. But I think at the same time, what technology is allowing is greater surveillance, greater monitoring in real time, which at the same time tends to counter that. So I think you've got opportunities on both sides, and we're not stopping technology, so that's not going away. So we need to develop those things in tandem. I think the other thing that technology brings is opportunity, in a sort of cost-constrained environment for shared services, utilities, that type of service. But at the same time, coming back to your cyber question, what does that do in terms of opening up centralized services to some kind of hacking, etc.? And I think we'll probably talk about that on and on through this entire panel, which is what are the risks to data and to the security around that, market manipulation, etc. So I think technology is here to stay, and we're going to have to deal with that.
Yeah. And an unrelated question, but in terms of all the regulatory developments we've had recently, and how do you think they will affect market liquidity? And do you think markets will stand up to stress? We've obviously had some things in the press recently around this.
So it's quite interesting. Over the 4 years, I've seen any number of documents which say regulation impacts market liquidity, and another set that say regulation does not impact liquidity. Strangely, the ones that say it doesn't impact liquidity tend to be written by the regulators, and the ones that say it does tend to come from the market. But I think we're through that now, actually, and probably in recent times, what you're finding is a better understanding of how the regulation is impacting markets. I mean, we had to have more regulation. I think that's a sort of a given fact. So how do we get the best fit regulation is really where people are coming from. And you're seeing that discussion coming from, I think Powell yesterday was, at the Fed, or the potential of the Fed, sort of talking about whether regulation's in the right spot at the moment. We've seen it with some of the European regulations, sort of discussions about whether it's fit for purpose. So I think we're at that phase now. Can markets, withstand a stress event? You'd like to think so, but I think what we do know is the last crisis is not likely to be the same as the next crisis. So I think it's a tricky thing to try and predict.
Is there a risk because of excess liquidity in the markets now?
I think there is a question about whether it's good liquidity, and I think you have to sort of take a view. You say there's lots of liquidity in the market, perhaps not always. We've seen certain flash crash types of events which are sort of unexplained. I think we're all trying to work out what that liquidity is, whether it's tradable, whether it's deep, whether it's whether it's there to stay.
Okay. Does anybody have any questions around resilience or effectiveness of the markets from the floor? If not, we'll move on. So we'll start with it.
Phil Aldrich at the Times. Just talking about the flash crash.
Can't hear you, sorry.
As Phil Aldrich at the Times, talking about the flash crash and liquidity issues in the markets. And recently we've seen big moves in FTSE 100 companies' share prices. Do you think that there's clear sort of evidence, clear evidence now that there is that algorithmic trading is one of the causes of these problems?
Let me save the panel a whole bunch of grief and go back to 2010 when I was at the CFTC. And it is a market structure question. And when we did see the flash crash, the original flash crash in the S&P 500 minis, we undertook a real serious investigation as to what was the cause of it, what was the driver, what market structures or events or behaviors created this environment that this could happen. And as a result, a lot of significant reforms came out of it. Collars, step downs around pricing, cooling off periods, things like that. We didn't try to stop it. In the old days, we would have stepped in and said, all right, everybody go out and have a cigarette, come on back, we'll trade in a half an hour. That does not work in this environment. It is a series of these moderate steps, some price collars that involve, and then they have to be unified across different markets. We caught a break because the flash crash occurred late morning in the US. and it didn't have the same contagion effect to either Europe or Asia at the time. So it was kind of isolated. But we did learn a lot from it. The other thing we learned from it, and James brought this point up, technology offers you a better look into the market. And that's very important, I think, from a regulatory standpoint. It took us a while to reconstruct the market. And it wasn't the T+1 transaction data that we had to look at in order to understand the behaviors and what was going on. It was 5 deep in the order book, 10 deep in the order book. And to reconstruct that, you wanted to see where the behaviors were, how people were bidding. We didn't have that at hand as a regulator. So I think that's one of the things that regulators, and I know, in the financial reforms, that's why data is important. That's why all these trades are being reported and better fidelity around that. But I would say that right now, one area that we ought to be working on is improving the data quality, not that, because everything is being reported. So it's not a question of if it's being reported, it's how it's being analyzed and developed and aggregated. And I think regulators are struggling a bit on how to do that. And it's not done consistently on a global basis, right? Each jurisdiction has you reporting differently in a different format, and to aggregate that back together, you can't get a good risk picture of a global marketplace from any individual regulatory seat. So that's a good place to work on right now.
But I think it's a very good point, though. I mean, we've said technology is here to stay. We're getting more and more data, how we handle data, how we're going to use artificial intelligence to work with that data, how much more we're going to get algorithmic trading. These are all very important points, and lessons are going to be learned, and I think there's definitely work to be done. And I think there is some theory or testing that algorithmic processes work very well in relatively normal circumstances, but when you get extreme circumstances, they may not necessarily operate as smoothly as one would hope. So I think it is a very good point, and I think there is a lot more work to be done there, but it's here and it will increase.
Dave?
Just wanted to add and really put in a plug for the Financial Stability Report published yesterday, which has a box on fast markets and picks out, put together by a study team led from within the bank that puts together some of the benefits that others have talked about from fast markets, from electronification, but also looks at some of the episodes of flash crashes, including the Sterling one, and looks at those from a financial stability perspective. And interestingly, the analysis shows how quickly, in all of the 3 episodes that I think the bank looked at, the market recovers, as it were. So these were very short-lived episodes. I think that that's relevant to some of the issues others on the panel have been emphasising.
I think just to pick up on that point, Dave, I think you're right. One of the challenges of finding out about flash crashes, liquidity, etc., is that machines are learning. And so the shape of trades are changing. People are putting smaller orders into the market rather than one big one. And so the machines are learning. And therefore, that's the next challenge. I think we were talking about it earlier on. What happens when machines start facing machines? And we're here to talk about some of the emerging vulnerabilities. And perhaps that's somewhere in the sort of volatile markets that there are challenges. And I think that may be an area that the FMSB may look at as a future vulnerability. Perhaps.
Absolutely. Okay. We're going to move on to fairness, actually. And we've heard already today about regulatory fragmentation. And Dave, I'm going to ask you a question. I mean, markets are global. Law and regulation is jurisdictional and divergent. What do you think this means for the fairness of markets?
Well, I mean, we did hear quite a lot about that just now from the governor. I mean, I think you have to look across. I mean, real markets are going to be balancing fairness and effectiveness. I don't really see this as a kind of dichotomy or even as a trade-off. And what you're seeing, and I think it is, as he emphasised, as Mark Yallop did earlier, is that you are seeing real leadership from the UK, from London, which is right given our leadership in FICC markets globally. But you are seeing others very much now on this journey. And as to the point, as the governor was saying, that you've even got things like the SMR being, as it were, repurposed, using different terminology, but exactly the same idea that you're trying to create the right incentives around a combination of the regulation, but then the behaviours, and how do you get that? How do you get that sort of that sweet spot in the middle so that you don't have total regulation and you don't have self-regulation? But my sense is, and it be interested in others' views, but my sense is that there really aren't. I mean, there are obviously some tensions here, and we were hearing about it earlier in terms of benchmarks. Different jurisdictions may go in different directions, but the fundamental issues and the fundamental behaviours are going to be the same.
James, would you agree with them?
Yes, I think one of the challenges of global regulation is, it was meant to start in the same place, and yet the sort of multitude of ways in which it's been implemented can sort of create divergence. And I think, you look at regulatory arbitrage for the sake of arbitrage is probably wrong.
Yeah.
But at the same time, you have to accept that people will make laws for their own jurisdiction, and that may mean that things are implemented differently. I think one of the sort of roles that FMSB can play is that it provides, if you like, not that it's international as yet, but it can provide that smoothing in terms of expected behaviours when perhaps some of what's actually written down on paper might be slightly different or nuanced. So I think there is that opportunity for FMSB to do that.
Manaz?
Markets are global, and actually most of the members of FMSB are acting in global markets.
Absolutely. Yep.
So by definition, and to a great extent, I think the UK has been a leading indicator of trends, has set the bar quite high, and I would say most of the other jurisdictions watch the UK very, very closely, and even if they don't have to follow exactly now, but I would say that they definitely follow it very closely, and they are setting themselves for the same rules and same pattern. So even though they may be fragmented a bit, but I think the UK really has been setting the bar. And then the other thing I want to touch on is rule-based versus principle-based. I think it's so important, going back to what you were saying, Dave, in terms of finding the balance and what the governor was saying earlier on. I think it's finding rules are important and is good to lay them out, but I think it's so important for the sector, the industry, organizations, to not lose sight of principles and have that overlay the rules. Because I think we run the risk of making people very comfortable by ticking boxes, and so long as they've gone by the rules and not asking the first principles and standing back and asking the basic questions. I think it's so important to maintain that.
And do you think there's a trade-off between fairer markets and effective markets? Is that a natural trade-off?
I think transparency is the key. I think the rest will follow. I think transparency. We heard from the first panel and from a borrower, what's really important to them is transparency, knowing how it operates, how it works. And then, whether it's price or process, etc., will follow and will be the right one for any particular scenario or transaction or structure. So I think transparency is key.
I think you're about to see a big revolution in market effectiveness. I think there's so many new inputs, and we've all been responding to the regulatory changes in the frameworks. And I'll speak for the derivatives space. You look at our market structure right now, you wouldn't design that from scratch. It's been this horizontal structure that is kind of layered on different utilities and functions and purpose and things like that. And it's something that needs to be completely rewired in many respects. You still need to be able to create that bespoke nature to tailor the hedging needs, and it's certainly not a fast market by any stretch, but it could use so much more automation. The back office costs, and now with the regulatory compliance costs, and on top of that, the capital costs, it is not fit for purpose. It is not effective at all. And so, we're looking at a kind of redoing the entire thing from beginning to end and saying, what do we keep, what do we need, how do we automate it, and how do we drive innovation here, right? And there's not a natural disruptor in terms of like current accounts or apps. That we have no app that's going to fix what the derivative market has, right? We need to look at this holistically and try to figure out what we begin with and start with. And it's really going to come down to standards, right? We've got standard definitions for products. We have standard contracts that we can all use globally. Now we really need to get kind of that fundamental and drive standards in the life cycle of a trade and different purposes. We're looking at new mutualized costs of different structures, things that are not competitive tools anyway, right? We want to compete on price, customer, location, services, but competing on sticky services, that doesn't make any sense. It's a cost center. It's probably not very innovative. It's probably a monopoly, and it's not effective. So we're going to be revisiting a lot of areas that can really be optimized, I think, and bring innovation. But it doesn't start until you can get a new standard driving the process.
Dave, please.
I'm conscious that I should have mentioned, I think it's worth mentioning, although the governor also mentioned it earlier, so I'm reinforcing his point. But I mean, the Global FX Code is, I think, a really good example. I hope Chris Salmon, the Executive Director of Markets, is in the room. Yes, I can see him in the room from the bank, has been leading this effort with colleagues globally. And you know, this has required an awful lot of convening, an awful lot of bringing together people from different jurisdictions. But we're at a very encouraging place with that. I mean, only today, I think we've had the ECB and 14 central banks from the ESCB who've published their statements of commitment to that. And as we were hearing from the governor, you know, that's drawn. I think the work in that drew on one of the FSMB standards. So you know, it's a really good example of the dynamic here. And the key thing is that is sustained in the face of all the challenges that we're talking about now.
Thank you. And James, big data, that's the other thing.
Yeah.
What are the risks with big data in terms of conduct risk and risks to the market?
Well, I think there's reward and risk. So clearly big data allows for better decision making, better analysis, better end user experience in terms of what they're being offered, etc., and the types of products that they may have access to. At the same time, of course, data lends itself to manipulation, it lends itself to sort of privacy issues, it lends itself to hacking, it lends itself to cybersecurity, etc. So I think that clearly the use of data and the risks for firms, actually, if you have to think about it, when the GDPR comes in next year, 4% of your turnover is the fine that you can have. Clearly, that, along with cyber, goes right to the top of the agenda in terms of risks that people are going to be running. But at the same time, using that data incorrectly internally from a conduct perspective is going to have to be right at the top of the list as well. And we heard Mark was talking about the information sharing document that's coming out of the FMSB. I mean, that clearly starts to, that's not data, but that's one end of the information discussion that you need to have about what data can and can't be used. Because once it's no longer verbal, once it becomes bits and bytes in a computer that people can access and they can start to say, oh, have you seen this correlation? Well, is that correlation right or wrong? Once the machines get involved with it, the algos start running, you know, what's it going to do to that data? So again, this is all going to start happening away from the human interface. And the question is, what is that going to do to trading patterns? How are you going to monitor it? What are going to be the rules that surround that data? I think is a critical issue that the industry is going to face over the next probably 5 years. I think that will become the burning issue for the industry.
And I think GDPR will be a massive issue going forward.
Yeah.
You know, people's preparedness for GDPR will be interesting going forward. We've got time for one more question, if anybody has a burning question. Otherwise, I've got a catch-all question for the panel. Okay, we're coming towards the end of our time. So we're talking about emerging vulnerabilities in 30 seconds each. What's the thing that, maybe I haven't talked about it, what's the thing that you think is the biggest emerging vulnerability that keeps you up at night? James, start with you.
Well, I'll start. It may not be the biggest one, but I think it's an incredibly interesting one. Cryptocurrencies, Bitcoin. 850% this year. The last person who said it was for murderers, drug dealers, and North Koreans. It doubled since that moment in time. I mean, where is the investor protection behind it? What are the systems that underpin it? Does it enter mainstream? The governor talked about the social license. People don't really realise the difference between retail and wholesale. That will be a space. If it continues where it's going at the moment, I think we could see some nasty things happening in that space. So I think that will be one where we should be starting to take notice.
Scott?
I think James is right, partly because of that retail feature. And if everybody's getting into it, the day my dad says I've got a crypto fund, then I worry a lot. But
trust fund.
Yeah, exactly. Yeah. It really is. It goes back to like benchmarks. It's these market fundamentals, how we transition. And so that's something that we spend a lot of time thinking about, making sure that the entire market, all $500 trillion of the global notional value, can move in a reasonable way and has a clear pathway to those types of things. And then there's a technology overlay, and it's rewiring the market infrastructure so it is reliable, transparent, and effective.
Thank you. Dave?
My colleague John Cunliffe talked about cryptocurrencies on the radio this morning, so I won't talk about those. I mean, I'll just mention the issue that others have talked about on the panel, but which I didn't have a chance to, which is cyber and cyber security, and really just to, obviously there's the market-wide importance of that, which the FPC and the PRC in their work are both very focused on. From a bank perspective, given one of my responsibilities, which I haven't been able to talk about today, but have already in public, is around the renewal of the real-time gross settlement system and making sure that critical piece of the existing RT system and then the renewal, those critical pieces of national infrastructure are safe and secure from cyber. I have a fantastic team, so I don't necessarily stay awake at night, but it is at the top of our risk register, I would say.
Thank you. Manaz?
Mine is probably slightly different. One is, Scott referred to it, the cost of business. We all are facing a lot of regulatory change and requirements, and we all know where markets are. And I guess my thoughts are making sure that organizations can invest in the change that they need going forward. And one of them is technology, which requires a significant amount of investment. So making sure organizations sort of channel their, whether it's human resource or financial resource, into areas to move forward, I think is quite key, and that balance is going to be quite important going forward. The other thing I would say is transfer of risk. The banks are highly regulated, all for good reasons, and still work to be done. But I think, again, as a global market and our users of the market, end users who are really connected to all financial sector, it's important to be aware of risk not getting transferred from highly regulated sector to a different sector. I think that's something to watch out for.
Thank you very much. Can you please join me to thank the panel for their candid